All right, well, welcome back everyone to Module 5 Lesson 3. This is the last lesson of Module 5 and the end of the program. So without further ado, let's jump right in. In Lesson 1, we talked about how to create $8,000 a month in passive income tax-free within 5 years. Then in Lesson 2, we took a look at the structure of how to actually track and create this money. And in Lesson 3, we're going to do the same thing, but now we're going to be focusing on using joint venture money or other people's money. So let's get started by taking a look at how to create $8,000 tax-free using other people's money. Again, we're going to be looking at this style of house, which is your high ranch or raised bungalow. And again, simply because of the floor plan, the layout, this is going to maximize the amount of space on both floors and just ease of conversion. If it's a single family house, to convert it into a suited house, it's just the ideal property to be focusing on. So that's what we're going to be looking at for our example. And again, the numbers that we're looking at an average price of $350,000 with rents upstairs of $1,400, the basement $1,100, and our overall profit or cash flow is $650. So when we're using other people's money, where does the down payment actually come from? Well, there's the method of recycling your own first down payment. So if you're able to come up with the down payment for property number 1, you're then going to be using joint venture partners and or just other investors to recycle your own first down payment into the second, third, fourth property. Or you could be joint venturing with somebody where you are both on title. So the joint venture partner wants to be inclusive and wants to be on title with you. And then for those of you who aren't interested in being on title, or because you may have poor credit as well as no cash, then we'll be taking a look at joint venture with you off the title secured by a co-tenancy agreement, which we've talked about in previous lessons. So for the rest of this lesson, we're going to be focusing on either of these two models here. It doesn't matter which one. They're part and parcel the same thing. All right, so what are some of the concerns that joint venture partners actually have when they're going to get into business with you? Well, first of all, they want to know how much they're going to make. How is my money going to actually be protected in the event that things don't go as planned? When will I be paid and how will I be paid? And if I want to be paid sooner, how can I be paid sooner rather than later? So those are the main concerns that most investment partners will have with you. And that's what we're going to be talking about today. Now, this is a little overwhelming and daunting, but I thought I'd show you this Excel spreadsheet. This is the spreadsheet that I've created in order to track the properties, the mortgages, the payouts to everybody, the interest rates, etc., and what the bottom line is going to be. Now, obviously, there's no way we can see this. There will be a copy of this included with the program that you can pull up on your own computer. But for today's lesson, what we're going to be doing is just highlighting small sections of the spreadsheet and zeroing in on different sections and work our way through the entire spreadsheet for tonight. So with the original 5-year strategy that I started out with, my goal was, or my plan was rather, that the investor and yourself would not receive any cash flow for the initial 5-year period. And this means that we would then put all of the monthly credits, so for property number 1, for example, the monthly credits of $600 would be applied directly towards the principal reduction and would accelerate the mortgage pay down. So that's what the plan was initially. But what the feedback I was getting was that very few investors are going to be willing to wait for 5 years in order to start receiving a return on their investment. And that's fair enough because most investors aren't going to have cash just sitting around that they want to use. They might be using lines of credit, and there's a cost of that. So what we've done is we've recalibrated this, and I'm taking some of the monthly credits and paying, in this case, $400 towards the investor, which is only going to leave $200 a month then to apply to the mortgage pay down. And by doing this, our mortgage pay down balance will only be $222,869 instead of originally it was just under $200,000. It was $197,530. So a significant difference in the mortgage pay down. So as a result, the cash out is going to be only $101,727 instead of $127,000. So that's going to result in a smaller payout to yourself and the joint venture partner. So in the first 5-year term, you can afford to pay your joint venture partner the $400 a month, and it's not going to have a real negative impact on the whole big picture of the plan. It's going to result in a slight reduction in the cash flow available. But here's where it became a little bit more of a challenge and more interesting. In the second 5-year term, when you refinance that property at an 80% loan to value, the mortgage amount is going to be higher. And if you're continuing to pay your joint venture partner $400 a month, then there's no cash flow for the mortgage pay down, or there's no additional cash, or there may not even be enough cash to pay the full $400 to the partner. So in order to continue, I want to continue to be conservative with the numbers. I don't want to be looking through rose-colored glasses or anything like that. I want to make sure I'm using realistic numbers for everybody. Plus, it's very important that whatever the program is, it is sustainable. So what I did was I extended the program to a 7-year period instead of a 5-year period. And when it came time to refinance the property, we didn't refinance at 80% loan to value. We actually refinanced it at 70% loan to value. And what this did was it creates a much more affordable mortgage because of the 70% versus 80%, which helps with the cash flow. It also creates a larger spread between the future value and the bank balance because you're adding an extra 2 years on there. Plus, you're also adding more time into the equation to get your rents up a little bit higher as well, which all goes towards improving the overall cash flow. So what we're going to do is we're going to take a look at the model based on a 7-year window. And each year we're going to be buying 2 properties with a joint venture partner. Now keep in mind, this is just an example. I mean, if you want to really be aggressive, you could buy 4 properties in 1 year with a joint venture partner, and you could fast track this whole program, really accelerate it. It all depends on your ability to attract joint venture partners and your ability to find suitable properties to fit the model. But for this example, we're going to use 2 properties a year over the course of 7 years. All right, so now the numbers are starting to get a little bit small here, but I'm going to add the numbers in for you. So joint venture partner receives a monthly payment with a bonus at the refinance time. So they're not getting all of their money up front. They're only getting a portion of it. So what I did was I selected $400 a month for the joint venture partners. And as a result of that, they don't get the full amount owing to them. Well, they get the full amount, but they get some of it up front and they get the balance at the end. So in this particular case, the balance owing to the joint venture partner at the time of refinance is $38,710. So the cash out for this, under this new model, the new mortgage less the balance of the original mortgage, the cash out is $101,421. This cash out is going to be split 50-50 with the joint venture partner and yourself, which means that each party gets $67,510. Now, as I mentioned earlier, the joint venture partner has already received $400 a month over the course of 7 years, so that works out to $33,600. So you'll see here the joint venture partner has already received this amount, which means that he or she's only going to receive the balance, which is $33,910. So when you take their bonus amount, the joint venture portion, plus the annual amount that they've received over the 7 years, they get the exact same 50-50 split as what you will get, but you just have to wait until the 7 years has expired. All right, so at the year one, the joint venture partners paid $400 a month, and that works out to being a 6.9% return on their investment. That's based on a $70,000 investment. So 6.9% is a pretty good return. I mean, that's definitely above, above the average return if you were to put it in a very safe, conventional investment vehicle such as GICs or even the bulk or the majority of the mutual funds. So most investors are going to be satisfied with receiving $400 a month. Now, if you can do it for less, $300 a month, that's better. But $400 is what we've used in this example. Now, at the end of the 7-year is when the joint venture partner is going to receive the balance of his investment funds. As I said before, what we do is we split the cash out of that particular property. And the cash out in this example was $67,510. You split that in two, and you take away the amount that they've already been paid, the $400 a month, and that means they've got $33,910.90 coming to them at the end of year 7. So when you put the two together, they've received a combined total of $67,510.90. That's the equivalent to 15% return on investment. In other words, if they put that $70,000 into any other investment vehicle, they would have to get 15% or more every year in order to outperform this particular strategy. So from an investor's perspective, I think this is a very attractive model because not only are they getting an exceptional return, a 15% return on their investment, it's also secured by a piece of real estate that they are registered on title with. It's insured with fire insurance, theft, and all those good things. So their money is well protected, and they're getting a very good return on investment. So this is a very easy sell. So what's in it for you then? Well, at the end of year 8, you're going to, or the end of year 7, when you pull out the money for year 8, you are actually going to pull out $4,000 a month from property number 1. So remember, your share of the cash out is $67,510. So from that, you pay yourself $4,000 a month. But you have 2 properties each year. So you get the second property, which is going to pay out $67,781, and you take another $4,000 a month. So instead of one property paying you $8,000 a month, you now have 2 properties paying you $4,000 a month, neither of which you've put any money into it. You're just facilitating the transaction and managing the properties. So it's all sweat equity from your side of the equation. So that means that $8,000 a month is actually infinite return on investment for you because you don't have any money in the game. Now here's where it gets a little bit interesting as well though, because property number 1 generates the $67,510 and you're paying yourself $4,000 a month. That means there's over $19,000 left over, which you place into a savings account. So you can see it circled in the red there. With property number 2, it's the same thing. The savings is $19,781. Now, after each refinance, this savings is going to accumulate. So at the end of year 8, you actually have $39,292.70 sitting in your savings account. If you fast forward to the end of that phase 2, at the end of year 14, that savings account has actually grown to just under $300,000. Now this savings account is going to be used for cash calls, maintenance, if you've got an underperforming property, or the market shifts, whatever the case may be, and you want to maintain your $4,000 a month income, you can dip into your savings. Or if it's an underperforming market and one property is only going to pay you $3,000 a month, you can decide whether you can get by with $7,000 a month or if you need to dip into your savings. You can also decide if you need to repaint one of the properties and it's going to cost you $1,000 to do the job, whatever the job might be. You can either take that out of your line of credit and pay it back through the cash flow on the property, or you can dip into your savings account. But that's what the savings account can be used for. Now, with year 8, property number 1, The future value is based upon a 3% appreciation. Again, early on I was using a 4% appreciation, but I wanted to be conservative, so I took it down 1% and we're doing it at 3% appreciation. The mortgage value is only 70% loan to value. So instead of refinancing at 80%, we're now refinancing at 70%, so smaller mortgage, lower payments, better cash flow. And all properties in this first refinance phase, so that's for the next 7 years, will all be refinanced at the 70% loan to value. So as I say, this provides for a lower monthly payment, therefore improving the cash flow for the investor, and also the mortgage pay down as well. It creates a larger spread. At the end of year 15, property 1 is going to generate $76,738, and I think by this point in time you can afford to give yourself a little bit of a raise, so you take out $5,000 a month, and that means your savings then are going to go to $16,738. So you do that for property number 1. Property number 2, at the end of year 15, your savings has grown to $218,133. You keep doing this each year for your 2 properties, and by the end of year 21, your savings account has grown to $360,429. And again, just to remind you that this savings account, you can try and focus on growing it as much as possible and leave it alone, or you can dip into it when need be. You'll also see that around year 18, I increased the income. You can see it right down here about the middle of the column. I went from $5,000 up to $6,000 a month, which decreases the savings that you're putting into your savings account. However, if you wanted to, and you're happy with the $5,000, you can maintain it at $5,000 and just focus on growing your savings account. Again, with year 15, the future values are always going to be based upon a 3% appreciation. And during the third phase of this, what we're going to do is refinance the properties at 65% loan to value. And all properties are going to be, in the second phase, they're all going to be financed at that 65% loan to value. So again, this provides, because the mortgage amount is getting larger, the smaller percentage is going to provide a lower mortgage amount, which will allow for a smaller monthly payment. You also have to keep in mind that there's going to be, over this 15 years, there's going to be growth in the revenues to offset it as well. So a combination of the two. The remaining equity is in the property is also growing faster because you're no longer keeping your equity in the property at 20%, you're actually increasing it to 35%. All right, so we've gone through 3 phases now, so a total of 21 years, and the question is, what do you do now? And I think that's going to be different for every person. It all depends on what age you start this program. If you started this program at age 50, you're now 71 years old. What do you want to do? Do you want to keep refinancing the properties for another 7 years or another 14 years, which you can easily do? Or do you want to start selling them off at this point in time? Well, I decided to, for the sake of this program, this example, I decided to start liquidating the properties at this point in time. So that's why we got them highlighted in red. Again, the future value is based on a 3% appreciation. So that initial property that we bought back at day 1 for $350,000, 22 years later is now worth $651,000. The sales price is 97% of the asking price. That's pretty standard in the market. It can be higher, it can be lower. It all depends on the market conditions. The mortgage balance in this particular case is based upon a 4% interest rate, so I did increase the interest rate slightly. The cash out at the end is the sale price less the mortgage balance, less the initial down payment and closing costs. And of course, there could potentially be other costs, depends on the market that you're in as to what the costs are related to the sale of the property. There could also be some charges or fees if you are using the services of real estate. All right, so let's take a look at your portion of the sale. Property number 1 pays yourself $7,000 a month and a savings of $67,927. Property number 2, the savings portion is $71,670. So at the end of year 22, the savings balance is now grown to just over $500,000. Now I put in brackets here, this is before tax, because there's no way I can calculate the tax for this because everybody's situation is unique and different. It depends whether you used depreciation at the onset or not, whether you have to reclaim that depreciation. It depends whether you have them inside a corporation, inside your own personal name. It depends on your personal tax bracket, etc. So all these numbers are before taxes. At the end of year 28, once all the properties have been sold and the proceeds have been put into the savings account, after year 28, you have $1.4 million sitting there. So let's just quickly go over a summary on the spreadsheet. I actually have a summary at the bottom of the spreadsheet, so I'm just going to go over that with you here now. So the income from year 1 to 7 is none, except for any finder's fees that you may be able to take advantage of, or any proceeds from other real estate deals that you're doing at the same time, which is what we talked about in Lesson 1 of Module 3. The income from year 8 to 14 is $8,000 a month combined between the two properties, and you also start a savings account. From years 15 to 28, the income grows to $14,000 per month, and again, it doesn't have to. You can keep it down at $8,000, $10,000, $12,000, whatever suits your needs or wants at that time. The savings at the end of year 21 is $360,429. Of course, that all depends on any cash calls that you incurred over the course of the 21 years, whether you had to put a new roof on, new furnaces, etc. And if in year 22 you start selling and then put in the savings, your savings will grow to over $1.3 million before taxes. And this could potentially last you another 15 years plus or minus at $8,000 a month. So again, going back to if you're 50 years old and you started this program based on this model, you're now 72 years old, you can start to withdraw $8,000 a month for another 15 years. Or you can decide to hang on to it for another 7 years before you start selling the properties, or any combination between the two. So you can sell a couple properties and just start dwindling it down, or you can get rid of them all, or just hang on to them forever. All right, now I do need to add a little bit of a disclaimer in here just to remind everybody that all of the information that's been provided within this worksheet and all other worksheets within the program itself is all hypothetical, but the numbers are very realistic. The results are definitely going to vary based upon the market you're investing in, depending on the market values of the properties that you're dealing with, the interest rates. Nobody can control or predict those, despite the fact that I believe they're going to remain very low for quite a few years. Probably 10 to 20 years they're going to remain extremely low. Appreciation rates as well. Nobody can predict the future, but based upon the history, a 6% average is what we've been used to over a 30-some year period of time. So I think a 3% is a fairly safe number. Economic conditions in your market can change drastically as well. There's no way of predicting that. And then, of course, there's your own personal goals and plans. Your goals or plans may be more aggressive or less aggressive than what I've put in the spreadsheet. So it all depends on your plans and, of course, your ability to stick with your plan. So to wrap things up for this particular lesson, the summary is, what do you need versus what you want? So when you're sitting in front of your computer looking at this entire program, just ask yourself, and be very, very honest with yourself. What do I need versus what do I want? When we ask this question at the live events, quite often we'll get people saying, well, I want $20,000 a month, income, which is fantastic. That's a great goal to have. But if you weren't able to achieve that, what do you need in order to live a very comfortable life? And that's where we came up with the 8,000, because once we got into what people's needs were, the average seemed to, it was anywhere between $4,000 or $5,000 up to about $10,000, which is why we chose the $8,000 a month. When do you actually need it or want it? Can you defer the proceeds from this program for 7 years? Can you defer them for 10 years? If you can defer them for 10 years, that just means you're going to have more money in your retirement. So again, it depends on your particular plan. What resources do you have available to you right now in order to get this going? Do you have the down payment for the first property and then get the second property going using recycled funds? The more you can do on your own without having to leverage joint venture partners, the less work is involved for you, because the fewer properties you will actually need. Identify what resources you actually do need. So if you have no money and you have no credit, well, now you know what resources you're going to be looking for. You need to find joint venture partners who have money and good credit who are willing to invest with you. Create your plan based upon what you have learned throughout this program. And once you've got your plan in place, take action. Don't wait. Don't wait for the perfect opportunity to come along. Initiate your plan, get it going. And then, of course, no matter what your plan is with whatever program, you're constantly going to be reviewing your plan and tweaking it on an annual basis. So that's it for the program. I really enjoyed providing all of this information to you, and I look forward to the live Q&A. I expect that there's going to be lots of questions with this, the last 2 lessons in particular. And when you do get the spreadsheet and you open it up, don't be overwhelmed. Well, let me put it this way. You likely will be overwhelmed. Take your time, look at it. If you're not a numbers person, don't spend too much time on it. Just go back and review the lesson and get a grasp of the concept and follow the concept and trust that the numbers will work out. If you're not good with numbers, though, I would suggest you do have somebody involved with you who is good with numbers, who can take a look at it and understand it and help you with your plan. And for those who are really into the numbers, I know you'll enjoy the spreadsheet and seeing the numbers. You'll probably find a little error here or there, or whatever the case may be. Again, this is not designed to solve your problem specifically. This is designed to open your mind up to a concept and create your own spreadsheet for you to follow to fulfill your own plan. So have fun with it. Enjoy. Any questions at any point in time, please feel free to email me at ken@5homestofreedom.com. I look forward to the Monday night call to review this particular program, or this particular module rather, with the 3 lessons. And over the course of the year, I will be hosting live Q&A specific for the 5 Homes to Freedom program. And I will also be updating any new information over the course of the year as well. So check back on a regular basis to see if there's any live updates. And I look forward to seeing you at the top. Take care, everybody.